Can you see only the presentation?
Yes.
Okay, perfect.
Excellent. Welcome, everyone. I'm going to give everybody a few minutes to get settled. Quite a few people coming in. I'll give everyone one more minute. Excellent. In order to be respectful of people's time, I will go ahead and start the webinar. My name is Megan Gala. I'm the Senior Marketing Manager here at Sensiba San Filippo, and we're really excited to present this webinar to you today. Welcome to the Everything You Want to Know About Sales Tax webinar brought to you by Sensiba San Filippo. We have some quick housekeeping tips before we dive in. First and foremost, we will be recording this, and you will receive a copy of the recording to the email you registered with, along with the slide deck and links to any other resources that could be mentioned today throughout the event. You will receive the recording by the end of this week, so check your emails for that and reach out if you didn't receive it. If you have any questions for the presenters, we ask that you please submit them in the Q&A box that is available to you. We do have the questions that you previously submitted that Elizabeth will be answering today, but please feel free to ask any other questions that come up during the presentation. Our session today is hosted by Sensiba San Filippo's Sales Tax Manager, Elizabeth Perez Gonzalez. Elizabeth supports our clients with sales and use tax nexus studies, tax registration, volunteer disclosure agreements, audit representation, item taxability, overpayment recovery, and exposure audits. Today is a high-level introduction to the state and local tax, and we anticipate it'll run about 60 minutes. If you have more specific questions about your situation, you are welcome to contact Elizabeth after the session. Her contact information will be included in the email with the recording and the slide deck. Without further ado, I will hand this over to Elizabeth.
Hi, everyone. Thank you, Megan, for that introduction. Megan touched a little bit about what I do, but just a little bit more about my background. I have been immersed in the sales and use tax world for over 10 years. I've worked mostly in consulting, different states, different industries, but I have worked in industry as well for a major restaurant chain doing their sales and use tax, and in e-com for women's apparel. And most importantly, I love sales tax. I know that probably sounds crazy to the people on the call because usually it's a thorn in your side, but what I like about it is every state is different. I love doing research, and I love giving our clients the right answer, because I do know that wading through the information that's available and trying to understand what the states are trying to say in their legal jargon when they write statutes can sometimes be difficult. So I really love clearing that up for people. What we'll be covering today is physical and economic nexus, some of the more up and coming ways that companies are creating nexus, and how states are getting more clever in how they are assuming that you have physical or economic nexus. Use tax, which is the forgotten transaction tax a lot of times. Exemptions, sourcing, as Megan said, the questions that came in from our participants, and if there are any extra questions at the end, happy to answer those as well if we have time. And if not, I can definitely get back to you via email. So the basics. When I'm talking to clients, I always tell them, I hate to keep saying this, but I do say a lot, it depends. It depends on the state. The rules vary per state, as I'm sure a lot of you have experience with. Sometimes you can speak generally about an issue because maybe some states are aligned, but there are, of course, always outliers. I don't think there's any issue that the states are kind of all in sync on, other than taxing people. Sales tax versus use tax. Sales tax is that tax that is paid to you by your customers for their purchases or purchases that you make for your company. Use tax is paid by you directly to the state for purchases that were not taxed, but they should have been. You know, not all sellers are going to have a sales tax obligations. If you are in the service industry and you're providing a non-taxable service, there may be no need for you to register because you'll just be reporting zero. If you're a manufacturer and everything you sell is for wholesale, you know, you're not going to have an obligation. You may have some need to collect resale certificates and make sure you're on top of that, but not paying out. And retailers who sell exclusively on marketplaces, such as Amazon or eBay, they're typically going to take care of the tax for you. So if you were to keep your selling all on that platform, you may never have to register and remit. And when we talk about Nexus, just for those that maybe aren't aware of what that term means, that is the connection that you have with the state, be it physical or economic, that allows them to impose their tax on you. So that is what Nexus means. There are two types of Nexus. There's physical, which is what we all have been familiar with since, you know, business started. The standard was you had to have a physical location, had to have employees, or you had to have property. But back in 2018, there was a Supreme Court decision that created economic nexus, and I'll definitely get into that in more detail. But instead of needing a physical presence, it's solely based on dollars and or the number of transactions. There's no physical or presence required, and the emergence of economic nexus has created a headache for many sellers. First, I'm going to dive into physical nexus. So, of course, like I said, this is kind of the nexus that we all know. The standard for having a business or employees, that's understood. But with the emergence of remote employees, that's definitely changed where people have nexus. You know, really with COVID happening and the lockdowns happening, that changed the way we all work. And I get emails all the time from our clients that say, hey, we have this employee, you know, they're moving to Washington or they're moving to Oklahoma. How is this going to affect our business? There was, you know, going back to COVID, there was a time where states said, if the person's there temporarily due to the pandemic, we're not going to impose physical nexus on you. But for the most part, states didn't make any statement about how having a temporary remote employee would affect physical nexus. 32 states took no position. So basically they left the door open for them to impose nexus on you. Only 13 states offered guidance. And like it says on my presentation, all of those waivers have expired. So if you have an employee who has moved because of COVID, it may be a good time to evaluate, hey, is that person going to be there permanently? Does it mean we have to register based on their job title? You know, really evaluate where you have nexus, because I'm seeing, and our clients, they don't realize that just simply having one remote employee will create nexus. Typically speaking, the employee has to be involved in the sales process or in the state performing services on your company's behalf. Those type of employees will almost always establish nexus. Some states do extend that to include administrative functions. So it doesn't even matter if they're not directly involved in helping you create a market in that state, having an accounting person, having an HR person in a state will often create nexus. And I think as time goes on, states are going to loosen up their language about what type of employee will create nexus. And my prediction is that any employee will create nexus, because unlike other types of business activity taxes, with sales tax, a state can impose sales and use tax against your business, even though the operation of the person is unrelated to like I said, creating a market in that state. So, it requires them to, have legislative sessions and change language, but having that be a fact, I definitely think that's going to come down the pike in the future. Contract employees can also create nexus. That's called agency nexus. And that is established when a company contracts with an independent sales agent or a service provider that travels into the state on your behalf, that provides services or takes orders and solicits sales. So we've covered employees, and now another aspect of physical nexus is property. It seems, well, it used to be very simple, right? You have a warehouse that's holding your property, that's nexus. But the states, like I mentioned previously about expanding the definition of what type of employee, they are working on expanding the definition of property and bringing more types of property into the fold and creating nexus for sellers. For instance, software that is held on a server in a state can create nexus. Even if you don't own the server, services like AWS, for instance, will store a SaaS client software on servers across the country to increase their availability. And if one of those servers is in Texas, Texas has taken the position that holding your software, even if it's on someone else's server, creates nexus. So if you are a SaaS company, you're using AWS, it would be good to evaluate where those servers are, which of course they can give you that information and find out what are the rules in that state. Have they said that having your software on their server will create nexus? Property rented or leased to others in a state. So this seems very minimal, right? It's different than having a warehouse. Say you are a construction equipment company in California and you're on the border with Nevada and you rent your equipment in Nevada. It's only there temporarily. That doesn't matter. That creates nexus. On the flip side, if you as a company rent property or equipment or real property in a state, that will create nexus for you as well. And something that's been around for a while, but I think companies are less aware of, if you deliver property on your own company-owned vehicles, that creates nexus. The states just consider that constant in and out of their state enough of a connection to create nexus. So we covered physical nexus, and the big issue now, even though this decision took place in 2018, is the big issue is still Wayfair. States took action immediately after Wayfair was decided in 2018. And for those that don't know, South Dakota versus Wayfair was a Supreme Court case that ended the long-standing precedent that you had to have physical nexus physical presence to establish Nexus. Now, the mere sales dollars or individual transactions into a state will create Nexus and will create the requirement for the seller to collect and remit sales tax on sales that happen in that state. So states took their time in writing the language. Some had it ready to go, but as of 1/1/23, all 45 states that impose a sales tax have economic nexus rules. This includes Alaska locals. Alaska does not have a state sales tax, but Alaska does have local jurisdictions that impose sales tax, and Puerto Rico. The threshold is typically $100,000 or 200 individual transactions. I've seen these thresholds change over time. A lot of states are moving away from the individual transaction requirement because, you know, $100,000, that's pretty material. But if I am a jewelry maker and my earrings cost $5 to $10 each, and I do 200 transactions, I'm not remitting a ton of sales tax into your state. And sometimes there's an administrative burden, of course, with collecting, $12 a month in Wyoming on your sales tax. It's almost not worth it. I've put some of the outliers here. There are, of course, those states with the high populations, lots of industry. In my opinion, New York, California, and Texas, they've made their thresholds higher because of what I was just talking about, the administrative burden that comes along with having to process so many sales tax returns. So New York is 500,000, and you have to have 100 individual transactions, which is helpful for tech companies. A lot of clients that I've seen, their software is expensive. And if they do 2 sales into New York, they can easily cross this threshold, but or the dollar amount threshold. But because they didn't do 100 individual transactions, they still don't have to register. So that can be helpful. California and Texas, they are pure dollar amounts, no transaction requirement. California threshold, by the way, of 500,000 also applies to in-state sellers when it comes to collecting local taxes. And I will go into that later on in our presentation. And Washington, their threshold is 100,000, no transaction requirement. Washington has become very aggressive in recent years. And not only do they have sales tax, but they also have B&O tax, business and occupation tax, which is a gross receipts tax on any receipts into the state. Doesn't matter if they're taxable or exempt. If you're a wholesaler, for instance, you may not have any sales tax to collect in Washington, but you will have to remit B&O tax on your gross receipts of wholesale sales into the state. There's also local B&Os just to make it extra complicated. And like I mentioned, first enforcement was in June of 2018 for New York. And if you will, if you look at a chart of when states came on board, they weren't all in 2018. So if you are thinking about doing a Nexus study or trying to figure out, what is my liability out there, you're not necessarily always going back to 2018 because, like I mentioned earlier, the states, some of them had to take their time to write the language. So a lot came on in 2019, a lot came on in 2020. So don't be afraid. I know compliance is really complex, especially bringing economic nexus into the fold. It just creates another layer of complexity. But I think there's a lot of companies that are focused on creating tools and technology that will help make this easier, such as organizing resale certificates and providing tax rates and providing tax compliance. So it can be daunting in the beginning, but it definitely can be done. So marketplace facilitators, touched on that earlier about if you are selling exclusively through a marketplace channel, you may not have any requirement to collect and remit. Those are your Amazon, Etsy, eBay, but even smaller platforms can be marketplace facilitators. And a marketplace facilitator is a business or a person who owns or controls a physical or an electronic marketplace and facilitates those sales. So they also have economic thresholds. They mirror the economic Nexus numbers for the most part, with the exception of Connecticut. But if a facilitator meets that threshold, now they have to start collecting tax on behalf of all of their third-party sellers. So if you think you might be a marketplace facilitator, but you're not sure, it's important to read your state's statutes on what their definition of a marketplace facilitator is. So use tax. So before Amazon was so prolific with the number of warehouses they had, I would see clients under audit get dinged a lot for Amazon.com transactions. Auditors knew that they weren't charging sales tax a lot of the time, so those invoices always got selected for review. Use tax, which you may see referred to as consumer's use tax in some states, needs to be reported to the state on your sales tax return if you have one. There's also, speaking of California, there's an annual use tax return, or you can remit use tax on your state's income tax return. So anything that your company purchases that you're going to use where sales tax was not in the invoice, say you bought it from out of state, you have to pay use tax to the state at the rate of where that item is being used. There's also other items that companies sometimes miss in consideration of use tax, and that's items that may have been removed from your inventory for internal use. Say you make cookies and you take some of those cookies out. And now we're talking about fresh baked cookies because of course there's the distinction between prepackaged and fresh will change taxability, but you make fresh baked cookies, you take those cookies out and you have a party with your staff. You are supposed to pay use tax to the state on the value of those fresh baked cookies. Companies may not have a huge use tax obligation if they don't have a high volume of purchasing activity, especially for internal consumption. In my experience, the companies that have that really material outstanding use tax liability are going to be hospitals, research facilities, restaurants. But use tax should still be a consideration for all companies because states are becoming savvier at monitoring specifically customs data. I have seen clients here at SSF get notices where the states, California said, hey, this item, this is a research facility and it's chemicals. These items were imported in, but I didn't see you do a use tax return, because they have the value, they have the name, the general category of what the item is. So they're definitely out there searching and trying to get all of those dollars that are owed to them. And another example is, the restaurant company that I worked for, they did business in Puerto Rico. Excuse me. And Puerto Rico, they come in through their port and they inspect everything that comes in to make sure that the tax was paid before you get to use it. So if we had a new shipment of plates come into the port, we had to get on the phone with Puerto Rico and pay them the tax on that specific item to get it released to us, because they were not taking any chances with you remitting it later on a return. They want the money now, and that's kind of a result of just the economic state of the island. They're really in need of an influx of funds, so that's why they're so strict on that. The burden is, of course, always, on the taxpayer to know what's taxable. So if you buy something and you think maybe it might be exempt, or there's some exemption that you can apply to it, you really have to make sure that that's accurate, because no one's going to tell you. They'll tell you when you get audited. That's when they let you know. Okay, so speaking of exemptions, I would say, I think we all understand that anything tangible that we receive, for the most part, is going to be taxable unless an exemption exists. Common exemptions are manufacturing, equipment, and materials. Most states exempt the purchase of equipment that's going to be used in the manufacturing process, because they want to encourage manufacturing businesses to come to their state. There's a few outliers, of course. There is items that become part of the final product. So like I said, if you bake cookies and you package them and you sell them, all of the, the flour, in some cases the packaging, those are going to be exempt for resale, because eventually somewhere down the chain, someone's going to pay sales tax on it. Certain medical supplies and devices, there's a lot of exemptions, mostly for hospitals, but of course, I think as consumers, we're aware of those exemptions when we go to the store, and certain over-the-counter medications, depending on what state you're in, those can be exempt. Services, of course, are often exempt. It's not applicable in every state. I would say Hawaii, West Virginia, South Dakota, New Mexico, those are the ones that really tax a lot of services, basically everything. But it's typically not a consideration for our clients, because those states that I listed, there's not a ton of economic activity going on typically. Software and digital intangibles, though, that's another, category that a lot of people will get tripped up. They'll, a software company that does business in California, where, of course, software that is electronically delivered in California is exempt. And they may assume that that's the case in other states, but it is not true. I actually have a map. I should have included it, but it's different colors everywhere, because everyone has different rules about how they treat software. It's just such a huge area of spend today with businesses. My prediction is that a lot of those exemptions are going to change, just because of the revenue that's being lost with the explosion of software sales. And as I mentioned on the previous slide with use tax, these exemptions are relevant to when you buy things as well. Not capturing exemptions can lead to big overpayments. If you submit use tax on something that you shouldn't have, it's important to make sure you're not overpaying, and if you are, to recover that, because that that's your right as a taxpayer, which is to pay the tax that you owe and nothing more. And to get specific on California, because I know we probably have a big California contingency here. California was one of those states that did not have a manufacturing exemption. But back in 2014, they decided that it would be a good idea to encourage growth in the state. So there is a partial exemption on manufacturing equipment and equipment used in research and development. Currently, the exemption is, I've got it here, it's about 4% on the state portion. The buyer would still be responsible for any local taxes and the remainder of the state portion. The buyer has to be in certain types of business. So these NAICS codes here, they pretty much cover any aspect of manufacturing, you know, tooling to farming and making wine. And then the two NAICS here, those are for R&D. The property also has to be used in a qualified manner. So exempt items are going to be machinery used in the manufacturing process, the parts to repair that machinery, computers that are used to control that equipment. Items that are going to be taxable are equipment that's used in the extraction process, computers that are used by accounting staff, you know, office furniture, things that are not directly involved in the manufacturing process, those are going to be taxable. And like I mentioned previously, if you are a manufacturer or you are in research and development and you did not take advantage of this exemption when you made a purchase in the past 4 years, that can be recovered. So, you know, it's not gone. There's of course some work that would go into recovering that, but you can get that back. And oftentimes, you know, these types of purchases, you know, machinery and equipment used in the manufacturing process, they're quite pricey. So that refund of 3.9375% can be pretty material. All right, I'm going to move on now to sourcing. When we're talking about remote sellers, items that are mailed or received at a location other than your business should be taxed at the rate where the item is received. And we call that destination-based sourcing. Software sourcing is more complex. I work with a lot of SaaS and software companies. You know, the gold standard that states would love to see is, where are those end users located? They would love it if every software purchase said, you know, hey, we have users we've got 50% of our users are in New Mexico and 50% are in California, and that you would apply tax as applicable. So in that example, you know, 50% of the cost would be taxed because 50% of your users are in New Mexico, and the other 50% would not be taxed because they're in California and SaaS is exempt there. This is hard information to get. And a lot of times, if your purchaser, your client doesn't give you that information on the front end, you know, that's kind of lost. But there are states, you know, Maryland has created a exemption certificate specifically for this purpose. So your buyer would say, you know, your buyer based in Maryland would say, I'm based in Maryland, but 15% are going to be in New York and 30% are going to be in Maryland, and so on. If that information, if that information is not known, the next best information would be the ship to address. And, you know, if we're talking about an intangible product, you know, nothing was shipped. But if the company is based in California, but their IT department who's going to install and administer is in Texas, and, you know, that's on the ship to on your invoice, that's what you would use. if there is, if that's not known, the next best thing would be whatever address is in your records, probably the bill to address. But as software sales become more prevalent and they become even more material, states are really probably going to want to see that information. And if you're a buyer, it's important for you as well, because if you've got users using the software all over the country, but you're being taxed in Texas, that may not be appropriate, and you shouldn't have such a large tax burden if 50% of your users are in Texas, but the other 50% are in California, where it's exempt. So if you're the buyer, it's advantageous for you to make sure that your software provider taxes your software invoice appropriately. So I touched a little bit on destination-based sourcing, which is pretty easy to understand, as is origin-based. It's much less common. Origin-based states require you to use the rate at your origin, no matter where you're shipping, if we're talking about intra-state sales. So say you're in one of these origin-based states, you're in Arizona and you ship to Texas, of course you're going to use the Texas rate. But if you're based in Arizona and you are selling all over the state, you are supposed to use your origin rate. California, I kind of touched on this a little bit with the economic nexus threshold for California that applies to in-state sellers. So California, of course, we love to be different in California, and California is a mixed sourcing state. So that means that the statewide sales tax is based on the origin of the sale, but the district taxes are based on, those local city taxes are based on where it's going. And so in the past, it was wherever you were doing business, that is where you had to collect those local taxes. But if you sold something outside of wherever you were doing business, it wasn't your responsibility to collect those local taxes. For instance, if there was a winery in Temecula, the sales that they made in their tasting room would be subject to the rate of tax in Temecula, but anything they shipped outside, say they shipped it to Palm Springs, they don't have to collect that Palm Springs local tax. But as of 4/1/2019, California is applying that $500,000 threshold to in-state companies. So if this winery sells more than $500,000 a year of sales that are shipped, now when they ship to San Francisco and Stockton, they are going to have to collect those local taxes. But I will say that, most remote sellers, they can't differentiate. Their systems cannot differentiate between, okay, I'm engaged in business in Temecula, only collect it here, but don't collect it, in Palm Springs. So most sellers, they just collect everything and they remit it, because it is just, for simplicity's sake, to make everyone's life easier, they do that. Same thing with Colorado. Colorado is a home rule state. So that means we have sales tax administered, the state portion is administered by the state of Colorado. And then anyone that wants to administer their own tax can do that. So Denver is, if you're a business in Denver, you would have to do a state return, and you also have to do a city and county of Denver return. Shipping in Colorado is not taxable, but shipping in Denver is taxable. So you have to tax the shipping only at the Denver rate, but tax the entire purchase at the state plus the Denver rate. It's very just onerous for people that are in business in Colorado to handle things like that. So like I said, for simplicity's sake, any client I have that is selling into Colorado, they are collecting all of the entire rate no matter what, because systems like Shopify, for instance, they're not able to differentiate between where you actually have Nexus when you get down to those nitty-gritty locals. So the next thing I'm going to jump into are questions from our participants. So the first question that I had come in is about a vendor that was kind of pushing back on this client's use of a resale certificate. So this taxpayer, they make test systems for their clients. The component parts that they buy to create these test systems are for resale. And of course, the final product is taxed. One of their distributors is asking for a resale certificate for each individual part they purchased, because according to this distributor, the state has told them they have to do this. But my response to this question is, per California Publication 103, Sales for Resale, a list of items purchased or a general description of the items for resale is wholly appropriate way to use a resale certificate. So in this situation, I would point the vendor to that publication. And I think to make, maybe they do want a breakdown of each part, but they should accept a resale certificate where on the description of items purchased, you can say, see attached list, and, make a spreadsheet of everything that you purchased from this company and hand that to them. They should accept it. And I know that they're saying that the state told them that you need a separate exemption certificate for each part, but not to harp on the state, but sometimes they're wrong and they don't know their own rules. I've worked extensively with the state of California, and I have run into more than one auditor that didn't understand, their own rules. And I think for the most part, they're pretty reasonable when you, for instance, point them to their own publication and explain to them the rules. So I wouldn't, all hope is not lost. I don't think you have to fill out a resale certificate for each individual item. Hopefully this will resolve your problem. And if not, you can always email me, and happy to provide you some language that you can use with your distributor. The next question was a multi-part question, and if I interpreted any of this incorrectly, please reach out to me afterwards, but I think I have it right. So this taxpayer, they rent a tent for 10 days every year for an RV show, and they wanted to know, why is the rental taxable? So if I'm understanding the question correctly, rentals and leases are treated the same way as a sale. So if an item is taxable, for instance, a pop-up tent that you would use at an RV show, that's going to be taxable. That's a tangible item. There's no exemption for it. Renting it and buying it outright are the same thing in the eyes of the state. So that is why that's taxable. Their next question was, if they get the tent from out of state and use local vendors to install it, would tax be charged? Knowing that this is from a rental company that rents these items on a regular basis, I assume that this is not the first time this tent is being assembled. So it would be exempt for the installation of the tent, because reassembly of items is not taxable. If it was the first time you were building something, that would be taxable, because they consider that fabrication. The tent rental would also be subject to use tax, even though you got it out of state, because it's taxable. If your vendor from out of state did not collect sales tax. So you're using it in the state, there was no sales tax charge. Now it's your responsibility to remit that use tax to the state. The same taxpayer also helps with the tent rental company. If their jobs are performed in another state, they want to know if they would need to register in that state for sales tax. So I touched on this earlier. States do consider that minimal contact of you renting your tent out in another state to be establishing physical presence. You know, I actually found an example when I was looking for the answer to your question. The North Carolina Department of Revenue found that a company that was renting workplace safety videos through the mail had created Nexus solely because they retained ownership of those tents. And that's really the important part, right? Is that you are retaining ownership, and that is what creates the Nexus. Is there a huge risk of a company such as the one in this question temporarily going to Texas and renting a tent for 10 days and coming back? Probably not. But I want to let you know that technically you are supposed to register, collect tax on your rentals, and remit it to the state. You know, like I said, are they going to fine you? Probably not, but there are instances where, you know, especially when we're talking about trade shows and just large gatherings of a very large amount of vendors, such as the situation that you're describing, where they will send a tax representative out to these events to take down people's names and get their information, and they'll go back and they'll research. And if they look and they say, XYZ tent company is not registered in Texas, let's send them a letter. You know, you could get a Nexus questionnaire from them, and they'll ask you how often you're coming in the state and what type of business you're doing there. But like I said, probably minimal risk, but I always want to give that correct technical answer so you have that information, and you know, you can make that decision about what risk is there and how much risk your company wants to take on. So just a little bit about what I do, because I've, you know, gone over a lot of issues that exist in sales tax. I want to let you know how I can help if any of the things that I brought up sound like, you know, they're ringing alarm bells. Well, hey, maybe we may have exposure here, or we need to get money back on manufacturing equipment we paid. We do Nexus studies here at SSF. We look at your sales data, your employee locations, your property locations, and we'll tell you, this is where you have Nexus, this is when you created it, and this is, you know, your exposure. We also can help with voluntary disclosure agreements, VDAs, which is where if you find out you have Nexus in New York and it's quite material and you want to take care of it, you can go to the state and say, hey, you know, I didn't realize I had this outstanding liability, but I want to make it right. So if you voluntarily go forward, they will have a limited look back period, and they will also, in most cases, eliminate all or most of the penalties, which can be quite substantial. In Washington, for instance, it increases every year, and it maxes out at like 39%. So it can really hit people hard. They usually, I mean, I've never seen a state waive interest, but interest is usually much less than the penalties. So that's the benefit of doing that. If you need help registering in a state where you have realized now that you have Nexus, we can help with that as well. If you're being audited by a state, you know, reviewing the auditor's work papers for errors, submitting claims for refund to offset liabilities, you know, those are important aspects of being in an audit, because when you are in an audit, the state's not going to look and say, hey, they pay use tax on all of this software that's exempt in the state and they shouldn't have. The onus is on you to bring that to them. So they're only going to come to you with what you owe. They won't come to you with credits. So it's important to have representation if you're in an audit and it starts to get messy. An item master review is another thing that I can help with. That is where every item that your company purchases is given a tax flag. So, or items that you sell are given a tax flag so that you know that when you're taxing your purchasers or when you're buying things for your company, you are applying the appropriate tax or the appropriate exemption. Overpayment recoveries, like I mentioned, with the manufacturing exemption, that's absolutely recoverable. And anything that you have paid sales tax on or use tax on in error is recoverable for a period of 3 to 4 years, depending on the state. So I encourage anyone who thinks that they have made massive overpayments in regards to use tax or sales tax to reach out. And finally, an exposure review, which is analyzing your purchases, your sales tax payments, your use tax payments, and seeing if you have exposure if you were to be audited, for instance. I wanted to check in with the team and see if there was any questions that came in.
Hi, Elizabeth. Yeah, we had 2 come in. Ren Anderson asked how to determine correct sales tax rate if the location you are shipping to is straddling 2 sales tax counties. And then there was another one after that too that I'll read in a second.
Yeah, so figuring out the rate is, if you are shipping a lot to various locations, my suggestion would be to engage with a company that provides updated rates so that you are getting the most accurate rate, especially when we're talking about states like California and Texas that have these locals all over the place. It can be very hard to figure out. If you don't do a ton of volume of shipping, pretty much every state has a tool where they will give you the rate based on the address, so you can look those up one-off and not invest in a sales tax rate provider. You can be sure that you have that accurate information because it's coming right from the state. And what was that second question?
It says, if our customer did not provide a partial exemption for the manufacturing credit at time of service, does the customer request the refund from the state, or does the customer request the refund from our company?
So in California, if you want a refund on sales tax, you are to go to the vendor. So if the person that asked this question is in California, which I'm assuming because we're talking about the customer not providing it at the time of purchase, they would come to you, give you the resale certificate, and then it would be your responsibility to file a claim for refund with the state for whatever period you paid that sales tax in. And then the state would give you the money, and then you are to give the money to your client. So it's there's a bunch of states that are like that, and they're not fun to work with when you have a lot of sales tax that needs to be refunded. But that's really the proper way to do that, because the state considers you the taxpayer. They're not going to give the money directly to the person that paid you the tax.
And that's it.
All right. Well, it's 10:55. I'm on time. There is my contact information, like Megan said, she's going to provide that. So I'll let her wrap up here.
Yeah, thank you, Elizabeth. That was wonderful content. I really appreciate it. And I'm sure the audience members did as well. As Elizabeth shared, and as I shared in the beginning, we were recording this webinar, and so we will be sending out that webinar recording along with the slide deck and Elizabeth's contact information to you by the end of the week. If you do have any further questions or more specific questions about your business and your sales, sales tax situation, you can definitely reach out to Elizabeth for further details. Thank you guys so much for joining us today, and I hope you have a beautiful rest of your day.
Yep. Bye, everyone. Thank you.
Bye.